Bonds are back at levels we haven't seen since the GFC. The US 30-year bond yield has surged above 5%. Markets are getting nervous and investors everywhere are asking the same question. Is it time to sell everything? Tonight we break down what rising bond yields really mean for shares, which sectors get smashed, which sectors actually thrive, as we give you our carefully selected ASX stocks that could benefit if this trend continues. I'm Philip Tortevsky, joined by senior analysts Janine Cox and Pedro Banales, and we are Wealth Within. Good evening.
Good evening.
Nice to join again. Interesting topic, very big.
Fantastic, isn't it?
Yes.
It's huge.
It's the big question on everyone's lips right now, whether it is time to sell everything. I just want to bring in Pedro as well. How are you, buddy?
Yeah, doing very well, guys. Great to be here and looking forward to unpacking some of this mystery around bonds, which I'm sure people will be very happy to see.
All right, so let's dive right in. Now, everyone's talking about bond yields right now. Why does this matter so much for the markets? I want to get your input here first, Janine, then we'll go to Pedro's. But obviously, the yield is up around levels pre-GFC. We have not seen that for a very long time. We all know what happened following that. Is there any risk right now that this is I guess, smoking gun that causes our market to sell off?
Yeah, I mean, bond yields are a bit of a red flag for our market, always have been. Before the GFC, I remember that well. And right now we've seen inflation continuing to tick higher and we're looking at bond yields going higher. That means costs are going up. So essentially it means that the value of assets get re-rated down, and effectively that means lower prices. Now, companies like tech stocks could be significantly affected by this because their costs go up. So that's what we're seeing on the market. And so investors initially will panic about that sort of thing, but I don't think it's a reason to panic right now.
Yeah, and can I ask, Pedro, I want to get your thoughts on that as well. And, you know, it's such an important point Janine mentioned because, you know, right now there's two trains of thoughts. You either panic and you potentially miss the rest of that boom run that's about to happen in the tech sector that we're seeing right now. Is it a time to sell from your end, or is it a time to protect the upside on as the markets are unfolding?
Well, I mean, usually when you see bonds rising, it's a factor of you know, two things that could be happening, and one of them is an economic recession about to happen. There's a structural issue happening. Or it could just be the fact that the governments are spending more. There's more investment. We've seen a lot of investment go into AI and defense spending. So there's just more demand for money. And that's basically what it is. When you see demand outstrip supply, and then you start to see these bond yields rise, well, it just means that there's more demand for that money, and it needs to flow onto the right thing. So right now, it doesn't seem like it's a structural issue. So for me, I agree with Janine. There's no cause for concern yet, but we're going to get into some charts which may indicate otherwise.
Yeah, all right. Now on that, recently the US 30-year Treasury yield pushed above 5.1%, the highest level since before the global financial crisis in 2007. Reuters and MarketWatch both reported that investors are becoming increasingly concerned about sticky inflation, government debt levels, and the possibility that rates stay higher for longer. But here's the twist. Rising bonds yields do not automatically mean you sell everything. Historically, there are parts of the market that can actually perform very well in a high yield environment. Banks can benefit because high yields often improve net interest margins. Insurance companies can benefit because they invest massive amounts of capital into bonds. And resource companies can outperform if yields are rising because of stronger nominal growth and inflation pressures. So the key is not to panic, it's positioning. Pedro, your thoughts on that, buddy?
Yeah, well, look, it's no surprise that I'm going to mention the energy sector. This is going to be one of the beneficiaries, I believe. And also have a look at the cyclicals, the banks, like you mentioned, the miners, and you know, stocks in those sectors that could actually benefit from this interest rate hike.
Yep. All right. Now, Pedro, I know you had some very interesting charts to show us regarding that bond market, mate. So take it away.
All right, so on your screen right now, I have the US 30-year government bond yield chart. So on the right-hand side, this is not price, this is the percentage yield. And you can see that we have been in an easing cycle ever since 1981. This channel downward channel has been respected all the way down. What a time to be in the market, right? Ever since the 80s, as money has been getting cheaper, of course, the share market has been booming. But we really hit that low point in 2020 where we started rising again. And right now, it does seem like we're in that rising cycle. And I've highlighted this area here, which is what we're talking about today. You can see June 2007. That was that pre-GFC level that we're talking about. And we're right back at that level right now. We're currently at 5.03% yield. So, the real worry here, and a lot of investors have, is that we've now established a new uptrend in the way of bonds. Where it really gets interesting is this chart over here. So this chart is overlaying, here in gray is the recession periods that we've had. So you can see there's the 1980 recession as well in the late 1980s. We've got the 1990 recession. We've got the 2001 crash as well, 2007, which was a GFC. That was a pre-GFC. And then we've got, of course, COVID. So these periods here, you can see that bond yields actually started rising before we had those recessions. So we see rising here, rising there, and then we had that recession. Bonds started rising, and then we had that recession. Rose a little bit over here in this period in 2001, and then we had the recession as well. And then during the GFC, which is what everybody's talking right now and what they're worried about, bond yields didn't actually rise as much as we're seeing right now. So it's not exactly the same as it was pre-GFC. Yes, we are at those similar levels, but it's not the same type of environment that we have seen back here. So I just thought, I'd highlight that whilst, yes, we are back at those GFC levels, it's not exactly the same scenario. And whilst we could be in a hiking cycle right now, things could be different. However, if we count at how many times it did rise before those recessions, well, that's giving us a pretty big indication that, we are in a bit of a danger territory right now. And I'll just finish off with showing this chart over here where we've got the 5-year bond, the 10-year bond, and the 30-year bond. These are the percentage yields. So obviously lower yields on the shorter term bonds. The longer term bond is much higher, but all of them are rising. So we are quite well into a hiking, more inflationary period here in terms of the economic cycle.
Yeah, well, I think that's enough of the negative stuff. Janine, how about we get to some positive stuff and pick some amazing stocks to combat this scenario if it is likely to unfold further?
Yes, let's do that. Now on the screen there, you'll see asset manager Pinnacle Investment Management Group, and this company will benefit from higher market volatility and increased demand for active investment strategies during macro uncertainty. And we can see that this stock is very cyclical, which is interesting given the nature of it. We can see a peak there in October 2018, another one here in 2021, that's about 3 years later, and then this peak here, which is approximately 4 years after that. So, and then followed by a lot of, sideways action or, and a significant decline. And we're seeing the same sort of thing unfolding now and possibly entering into this period of volatility and choppiness where it could go sideways for a little while before it takes off again. But at the moment, it's looking like it's starting to set up better than what it did in the last decline. So if we come across and have a look at this weekly chart, we can see that when it came out of this low, it perhaps hadn't had the chance to unfold like we have seen more recently. And it actually bounced down to test the prior low, and it did that numerous times, like just skidding along the ground. Whereas this one here, we're coming up, nice little consolidation is unfolding here, very different to the scenario back here. Looks like it has potential to take off if it can get through some of these highs here. This could be very nice for Pinnacle Investment Management Group. This low is something to watch, this one in April 2026, I'd suggest. If it goes back through $14, then I would just sit tight and hold it, and not necessarily hold the stock, but just sit tight and hold your money, more like it, and wait.
You know what I find really interesting? I mean, Pinnacle is a stock in the higher market cap space on our market, and you spoke earlier about re-ratings, and I was having a conversation with a new student that came on board and said, how do you pick, in this environment, how do you pick the right stocks or what to get to? And, it's so important. A lot of the re-rating stories that we're talking about, if we're looking at the US, okay, things are flying in certain sectors, but there are a lot of stocks that are falling. And to me, healthcare springs out right now in our sector. Stocks like Pinnacle coming off 30-40%. Other big stocks in the top 100 that are being re-rated right now as we speak. So it's not all bullishness. It's, and the answer to the question was, hey, first check this book out right here. It's How to Beat the Managed Funds by 20%. It's free. You just have to pay the shipping. The link is in the comments section or in the description in this video below. As always, if you want to learn the professional standard, go and check out our government-accredited share trading course, Diploma of Share Trading Investment, on the website, wealthwithin.com.au, and go and check those testimonials out to show you what is possible, what our clients are achieving right now, which is amazing. But, back to that point in answering that question, it's, to me right now is you need to be on these, on the individual spectrum, looking at stocks individually and looking case by case, more so than going, I'm just going to buy this sector, or I'm going to buy this market, because you're going to find some gems and they're going to come right under your nose if you're not watching.
Oh, look, you're right. And now more than ever, people need to know how to actually filter the market for the right stocks. It's going to be a stock picker's market more so than just buy into the market and then... Because I think last year it was more about the small caps and the mid caps. Yeah. And now it's changing. Now you've just got to be so selective with the stocks, which is why you need a good set of rules to choose them.
Yeah, and it's funny, and like right now everything in the media it's all bullish. It's all markets at all-time highs, but underneath...
Look, you know what? When that happens, I mean, I remember when the GFC was unfolding, prior to the GFC, a number of sectors made tops well before the peak of the market.
Yeah.
That was probably a year or 2 years even with some sectors, and the same would probably be said in the US. But that's why you have to keep a look at all, an eye on, I guess, on all the sectors. But then, like Phil said, you have to be quite selective with your stock selection.
Yeah, you'd be surprised what opportunities come about even when the market does turn. But let's go and look at our next stock, Pedro, NWL, mate.
All right, so this is another one in the financial sector, and this one has pulled back quite nicely as well. This is a wealth platform, Net Wealth, NWL. It earns a higher interest income on client cash balances when rates remain elevated. So if we do see that continuation of the rates, that should bode well for this company. And it's come right at a good technical time. You can see that this momentum that it established back here in COVID. And this is a fairly, I would say, new stock to the ASX. And when I say new, I mean it's 2017, but compared to many of the others that we've got, back from the 90s, this is fairly new, and it's just been on a tear since. It's not one of those IPOs that actually was sold off out of the IPO. It's been trending higher and higher, which I like to see. So we do have this trend that has been established. It's coming back to it right now. It's also coming back to a previous all-time high levels. And these are all, the languages that we talk, all-time highs, levels, momentum, and everything. This is really something that traders should get used to knowing, because it's quite important. We just throw them out there as if, it's nothing, but it's very important to be able to apply analysis to these levels. There's special ways that you can, signify and actually project forward as to how high the next run could go. Because right now I'm looking at these highs, like this one back here in 2008, it was a high of $10, and then we've got a high of $18, and then now we've got a high of $38. So all of these have a relationship to each other. So it's important to know how to be able to project that. And, going back to what you guys were saying about how important it is to know and to pick those stocks, that's exactly what technical analysis is about. So going to the weekly chart here, the momentum is truly down. It's fallen around that 48 to 50%, and usually stocks do tend to turn around that level. Right now, it's giving no clear indication that it is about to turn, though. That's something to be mindful of. It's still pointing to the downside, and if it does break that prior low of $20, then you could expect further downside. But there is a very strong support there, and that support has been tested 1, 2, and 3 times. So I would say that this one is definitely one to watch for a break of that momentum.
Awesome. All right, Janine, next one.
All right, the next one is QBE. Now, some of you like insurers because you like the income. Insurers typically benefit from rising bond yields because they invest large pools of capital into fixed income assets. So you can see that, QBE's been on a bit of a tear over time. It had a pullback. We saw a decent pullback. It's not immune from that. And I'm going to pan back and show you the history of QBE, which is really interesting to watch. But 23% down. We've seen it move up to challenge that high. If we pan out, you'll see the full history of that. And we can see that when QBE went on a big run, it actually almost went parabolic in terms of that rise. And we're seeing a nice steady trend. It's going up on a beautiful angle, but we haven't really seen anything sort of, take off and euphoria yet. And it's still got plenty of time to go to that all-time high. If we look at that, we can see up around 40% upside potential.
Awesome. All right, let's get to our next stock, Pedro, ASB.
ASB, so this is a shipbuilder, and this is going to actually benefit from the defense shipbuilding, capital flowing into it. It's leveraged to rising global defense and infrastructure spending, which often continues during inflationary environments, and it will definitely continue with all the little sparks of war that we're seeing across the globe. It is very cyclical as well, so it looks like it is just coming down at the end of that cycle at the moment. And if you were to look at this on a monthly chart, you wouldn't be touching this at all. It's really a falling knife at the moment, but eventually it will turn around. And what I like about it is when we go to the weekly chart, there's an early sign of a possible reversal right here. And that's because it opened low and it's closing higher, which means that the buyers could be coming in. Volume hasn't really come in to support it, but this is a very important level for ASB as it's had that rise and then now fallen to a certain amount. And I'll just quickly outline that level there, which is that $3.80. It was an important resistance and support level back in 2020. So keep an eye on ASB. This is one that we've talked about in the past. We were actually talking about it before it took off in 2024. This could be the second chance for Austell.
All right, Pedro, how about you just cover the last one before we move on, because we have got some more amazing stocks for you coming out of this segment, and also one of my favourite stocks coming out of the viewer questions, so stick around for that. But the last one I think we've got before we move on is SGH.
That's right. So SGH, another opportunistic buy on a pullback. So you can see a bit of a theme with these. It's a diversified industrial and mining services business with exposure to infrastructure, energy, and resource spending. 3 key areas where it is set to benefit from an inflationary period. So it is in an uptrend. It's in a long-established uptrend. You can see that the momentum did really shift around this period here in 2022, where the momentum just went basically parabolic. It has broken that momentum at the moment. So the risk is that it does come back to around that $25, and we do see that there is some support around 23. But hey, it would have to fall pretty sharply to be able to pinpoint that level here right now. So there is a possibility that this does then take off. There is a small support level around that $35 where it recently found support. So quickly on the weekly chart, there are no signs of a clear reversal at the moment. It's currently trading around that range that it traded around in 2024. But keep an eye on it, because you could just put a simple momentum and wait till it breaks that to the upside. And you'd want to see volume coming into it as well.
Definitely a few stocks to watch, but let's move on now. We'll get into some amazing stocks later on. But time now for our special trending topic, Janine.
Very interesting. One of my favourite topics, BHP, has taken centre stage as debates on climate policy erupt in the iron ore space. We will take a look at the impact on BHP's share price shortly. But first, documents obtained exclusively by Four Corners and The Guardian reveal BHP is forecast to cut in emissions by just 1% by 2030 for its WA operations, which account for 30% of BHP's global emissions. A BHP memo titled decarbonisation plan discussed how delays in adopting electric vehicles powered by renewables would affect the company. It discussed one risk of not acting could be material in terms of changes in the diesel price. For example, the federal government's diesel fuel excise being revoked. The Guardian indicated that BHP purchased more diesel-powered trucks, which is inconsistent with its climate pledges. According to Clean Energy Finance, BHP is the biggest beneficiary of government rebates on diesel, making fossil fuels cheaper. And this is a strange way to encourage investment in electric trucks. Someone who may be happy about all the fuss is Fortescue's Ziggy Forrest. He wants a cap on the diesel tax rebates. Now, Fortescue planned to spend something in the order of $6 billion from 2023 to 2029 to reach real zero emissions. Interesting, hey?
Yeah, and we've been talking about this for so long. Like, how realistic is this transition and how quick is it going to happen by that
Well,
date?
I think the companies have got all of the excuses under this sun, given what's going on in the US. I mean, you see pictures of Trump there behind this whole diesel, the excise cut debate. So, I think he's got someone pretty significant in his camp in terms of the CEO at BHP arguing for just let it lie. But Forrester's Ziggy's really in there behind it all.
I mean, at the end of the day, they're always looking out for number one interest, which is the shareholders and
sure.
And the bottom line.
Previous CEO may have made the decision, and they put that in place, and then a new CEO comes on board. Conditions change, the situation changes. They make a decision from a business point of view. That's just what happens. But then it's right in one sense that the people who are arguing about the climate scenario and the promises that were made by BHP are now being broken. So that's, there's an argument on both sides.
Yeah, and I think if you tie it all the way back to when, Warren Buffett made that big bet on fossil fuels a few years ago where, we all went, oh, that's a, big, bold move.
What does he know that we don't?
Right.
He always knows something.
Yeah, and I think that story's being uncovered right now. We're seeing it a lot coming out of the AI space, that the compute power or the energy requirements for this new revolution in technology, it's just not there. It's going to be chewing up so much more energy, and that's why this conversation, and I'm diverting here away from BHP because BHP is just caring about what's best, for them right now, or what's most, applicable, But
I guess the thing is, should the government cut that rebate, that a diesel excise rebate?
Well, I think
if Ziggy Forrest's arguing it and he's put so much effort into going down that path, why are we allowing one to do and one not to?
Yeah, I mean, at the end of the day, it's a fine line, right? The government really doesn't want to hurt any more producing companies in this country because they'll leave. We don't want anyone leaving. They're already leaving in droves, so it's a tough one.
It is a tough one.
But in terms of the share price, are you going to show both BHP and FMG or just?
Well, I mean, at this stage, I've just got BHP up. Simply because, it's the star, isn't it? I mean, it looks fantastic in terms of the way it's unfolded. So none of this is really hurting BHP. If anything, it's supporting it to the upside. So Rio and BHP, we're in a similar situation, I guess, and FMG is the one standing out who's I guess, done the right thing, really, from a big picture point of view, based on the targets that were set at the time, and is heading that way. And someone argued that the amount of money that BHP would have to spend over 25 years to rectify this and go to renewables is, I think it was less than 1 year of their revenue or something like that. I can't recall exactly what the figures were, but it was something in that order. And when you think about that, you wonder what the argument is, don't you?
Yeah.
So if we look at the chart and we see how interesting this is from a point of long-term picture, there's something always there to learn whenever you're looking at these charts, but we can see this long-term level that BHP has been tracking around for 4 years, essentially, and it's finally broken out of it. Knowing BHP and the history of BHP, as I do, this is a really great start for BHP. I mean, we've seen it break out here and make incredible gains. This was prior to the GFC. That's nearly 400% rise through that run there. And since the low in 2016, it rose 295, let's say 300, let's be nice, and probably about a bit more than 300 to these highs here. Now, off this low, now that we've changed trend, the angle's accelerated here, it's accelerated here, we're going on a completely new trajectory now, this current rise. So given the rise that we've seen, it's already risen 100%. It can go further. And
does that
I think
concern
we've said
you, that rate of rise, that speed of rise? Is that more concerning than promising?
Because it's BHP and because BHP's been held back for 4 years, and this is sort of pent-up adjustment in my view, and it's adjusting to what's going on as well, obviously. But looking at this, I just think it's been a long time coming, because BHP's, we're technically in a boom. And at the end of the boom, there's got to be a euphoric rise. And the euphoric rise can last for a few years. But as I said, I'm still expecting, until my analysis tells me otherwise, that we're going to have a peak sometime next year.
Well, I'll pose it this way, on a scale of 1 to 10, because I mean, BHP would be probably in most people's superannuation portfolio, so it affects everybody right now,
Yep.
Investors and whatnot. On a scale of 1 to 10, over the next 2-3 years, how important is it knowing when to sell for BHP where it is today?
Critical.
Like 10, 1?
Oh, in terms of timing?
No, I mean in terms of importance, knowing when to sell and watching it.
Oh, gosh. I mean, it's everything
right
now, because BHP is going to tell us when the market top's coming. Prior to every crunch, mining stocks were, charging to the top. So I think it's going to be the same scenario this time. Yeah,
there you have it. If you have had questions in the past or wanting to know how do I sell, which is what we often get here, please, there's never more important time to know when to sell, so you can keep what you've made over the last couple of years. So please go and check out the website again and go and look at the course, because it's going to alleviate all of those questions so you can sell right and keep all your money. But now let's get back to our topic and get into some more stocks. Pedro, this is a good one. Capstone.
Yeah, Capstone. So this is one that we've talked about in the past. It's a stock that's in the copper industry. And of course, copper is positioned well to benefit from infrastructure, investment, electrification, and ongoing commodity demand. So as inflation comes in, obviously the cost of these commodities are going to rise. And it's already had that flush out. This is what I like. I'm going to go straight into the weekly chart, because this is telling me a little bit more. You can see that it is a fairly new stock. It IPO'd back in 2024. So we had that rise from that low here in 2025. And now we've already had the pullback. And now which way does the direction look like it's going? And that's up. Now, if this trend is any indication of how this stock trends, then I would not be betting against this current trend that's been established right now. It's made a higher high, it's had a pullback, higher high, had a pullback. Now look at what it's done. It's had that higher high. So it is wanting to push to the upside. I actually do quite like Capstone Copper. I think it's in the next leg, and the only thing that it needs to do is make sure that it can get past this previous resistance of around that $15. But apart from that, I don't have any problems with this one.
Yeah, fantastic. All right, another material stock coming up.
This one's interesting too. Pedro, the one that you were talking about obviously doesn't have a lot of history, but this one has a lot of Sandfire. Goes way back to early 2000s. We can see there when it was trundling along the bottom. To be trading that stock then, because look at the huge rise that we saw. But
we covered this on a hot stock tip back in early 2024. The question was, can it make a new all-time high?
There you go, and it did.
And you could buy 10 courses for that.
Yep, that's what it would more than pay for that, wouldn't it? And taking the family around the world.
Oh, that's nice, yeah.
Okay, so here we've got a rise of 1,671% off that sideways consolidation that happened. And now we've got another one. I mean, essentially it's larger, but it's still a consolidation nonetheless. And we're now looking at a change in terms of percentage, but obviously we've got 163 there already. Could it do that sort of order? Often the biggest rises tend to happen off those lows, you'll see. But I still think there's potential for further upside. We still need to make sure that this low is in March 2026 low. So I'll just switch across to the weekly chart so we can get a better idea of what's going on. Look, if this low holds, the May 2026 low, the stock could keep going up, and it could go up in the order of, I'm just giving you an idea based on, this is not analysis, so people think that when we're looking at this, we're doing analysis, but I'm just doing it in my head at the moment to see what I can see. I would say that there's a real possibility that it could go closer to sort of $28, $30 if this low holds May 2026. So that's what I'd be watching right now. I mean, the trend, the shorter term trend that's come off here, sorry about that, I've just picked the wrong one. We go off this one here. You can see there it's still nicely held along the angle of that trend there and has bounced off it, tested that. But is that enough of a test at this point in the rise? We'll soon see. So just be patient and wait and see. But if you're not in it at this point, I would just watch to see whether this low, first of all, 22nd of May gets taken out. If not, it keeps going up. There could be further upside on the cards for Sandfire.
Nice. All right, Pedro, next stock.
All right, so this stock doesn't need any introduction. It's NAB. It's a bank, one of the big fours. So higher bond yields can improve bank net interest margins and profitability, particularly in business lending. Now, technically, this is looking beautiful. It's come back to that overall trend, and you can see that once and twice already it's respected that trend. So we should assume that it will respect it once more. And there is indication here on the weekly chart that it is doing so. What I like about it is that we are seeing now volume starting to increase as we are now seeing price start to reverse. This has got great fundamentals. This bank, this is probably one of the ones that gets me a little bit more excited than the others. This one and Westpac, I would say. Let's expand out the monthly chart here and have a look at what's happening. So it's come back to that all-time high level. That was the previous all-time high. It did make a new all-time high at around that $50. So it's now back below that level. Now, if it was willing to trade above that level before, then we could expect that it is going to trade above it in the future sometime. It doesn't have to, but the overall consensus of this stock is up. When you look at just the overall momentum, and this is what we tell our students, I always focus on the overall picture. Is this stock expanding or is it contracting? And I would pose that question to you right now as a viewer. When you're looking at this stock, even though you're seeing squiggly lines everywhere, what's the natural consensus of this stock? Is it expanding or is it contracting? And for me, the overall trend is largely up and it's expanding right now. So I would think that maybe the next move could be to that upside. It still does need to break that $42. But this is NAB. It's looking quite nice at the moment.
Yeah, definitely one of those reversal stories. I mean, we've shown 6 or 7 stocks already, and they're all, again, going back to that conversation we had earlier, there are so many stocks on this market that aren't at all-time highs, big stocks that are re-rating right now and potentially giving you that next opportunity. So keep a very close eye on those stocks. Our next one is...
it's IGO.
All right.
Now, this looks interesting.
This is definitely re-rated.
Yeah, exposure to battery metals and long-term electrification trends supported by infrastructure and energy transition spending. This actually looks really good. And
who says renewables are dead?
Yeah, that's right. And this pullback is really the test that we needed to see. And it's now, this month, starting to prove itself. But we've still got a little bit to go to get there because it's making significant resistance now with this sideways move that we've seen a bit of a pullback and then trying to test it again here a month ago, April. And again, last week we saw a push up. It's really, really wanting to go through that high. That's how it looks. But you never look a gift horse in the mouth, and that's a very true saying with the stock market. So, I would be watching that level there like a hawk to see whether it actually takes it out or not. If it did, I'd let it go. Don't try to get this thing cheaper. That's not a way to think when you're playing with these sort of stocks. So, but IGO, I think, looks from a more of a trading stock. I think it looks the better one of the lot.
Yeah.
At the moment.
Oh, this is definitely my favourite so far, especially if it can break that 920. Just on the, if it does get through there, where do you think this could run to? Because, I mean, is the all-time high the limit?
Now, that's a really interesting question, right? Because I was talking to someone the other day who's done our short course. And then I said to her, if I had have spoken to you when you were talking about doing the short course, I would have recommended that, based on what she was wanting to achieve, that you do the full diploma because not only can you work out the strategy, but then with the Module 4 teaches them how to work out where a stock's going to go and where are the warning signs, what are the things to look out for, and how far could it run. And that's all part of factoring in the risk that she was going to set for her trading. So for me, this stock, it just stands out as being, is screaming that, you know, in terms of the upside, it would justify a trade because there's a potential here. There's sort of, you know, somewhere between 20 and could even be as much as 50, around 50% if it really gets going.
Yeah, awesome. All right. Last stock, Pedro, before we move on. What have you got, mate?
All right. Yeah, sure. So the next one is Ventia Group Limited. So this is another infrastructure play. A lot of people may not have heard about this one, but it's a services provider with defensive government and essential services contracts that can remain resilient in volatile markets. And it's exactly that. If you had to pick one word to describe this stock, and it's resilient, because this has been really up ever since it IPO'd back in 2021. The momentum has really been to the upside. And I'll just highlight that, just that natural momentum where it kind of swings around, and you can see that it ebbs and flows around that momentum there. And it's now shot up. I'm not sure if it's too late for this one. If, you know, just for a short-term trade anyway, if you are looking for that short-term trade, I'd probably wait for a bit of a pullback. But for the long term, I mean, the trend is your friend on this one. It's, you know, if history repeats itself and keeps repeating, then this one should continue to rise. I'd be looking at the fundamentals on this one to see if you can support it. At the moment, like I said, I'd like to see a little bit of a pullback, ideally to around this level here, around that $5.40, see if it can support itself again, and then look for a bit of a trade. Of course, there's trading strategies that we teach in the course that can get you in at a more opportune time, or there's more conservative types of entries. For this one, I'd probably look for that opportunistic type of entry at an earlier time if it does pull back to these levels. This is why I mentioned that I probably, you know, I'm quite happy with what it's done so far. It's broken above that downward momentum, but still, just to get a little bit of a better entry, it'd be nice for it to pull back. But hey, you don't always get what you wish for in the market. You just have to get what's given, right? You can't affect what the market does, but you can affect what you do. So I'd just be keeping an eye on this one, see if it breaks above that $6.40, or see if it pulls back, and then see what it does at that $5.50 level. All
right, awesome. Now we've got an amazing hot stock coming, but before we move on, what is the pick of the bunch? Pedro, I'm going to go to you first because I have an idea what Janine's going to say. What's the best stock of that bunch for you, mate?
Well, look, I'd have to go IGO, but I know that's you guys' favorite as well. My second favorite is going to have to be Capstone Copper. I think that one is looking quite beautiful and breaking to the upside.
Nice. Janine?
And I'll go QBE for you know, the investor side, and IGO for the trading side.
One more?
No,
I'm joking. No, I'm joking. Normally it's
somebody help me out here.
It's more than one. That's what we expect. But anyway, let's move on and answer your questions. Now, first up, we have Brendan, and he writes, I bought EDV not really knowing what I was doing. I intended to place an order for $25,000 worth of shares, but I accidentally bought 25,000 shares at $4.93 each. Initially, the shares performed very well, but I've now lost confidence that the share price will ever recover anywhere near my original purchase price. So my question is, do I sell now and realize a $45,000 loss, or do I double down and invest another $50K in the hope that the price recovers halfway back to my original entry point? Also, what sort of bottom range should I be watching for? Janine, I'm going to go to you on this one.
Yeah, I feel like I've got to be the unkind friend here.
Sometimes that's the best advice.
I think so. And look, you know, I really want to say I feel for you, and it's very stressful. You know, when you're inexperienced and you go to put a trade on, the first thing that you have to do is go and check that contract note against the trade that you've placed. And if it wasn't right, you go and reverse it and set it to what your intention was. I mean, I've heard of this before. It's not new.
It happens so much in FX as well. You know, people think $1 equals one contract, but it's $100,000. Yeah. Yeah.
So it's easy to do when you first start out. So just remember that. You're not alone. You know, we hear you. The question now is, what do you do about it? You're in it and you've stuck with it, and it just hasn't worked out for you. And my heart goes out to you. All I can say to you is that you've got to decide how much you want to risk from the outset, and then stick to that. So if it falls away, you've got to have a stop loss. Depending on I think he was down about 50% or something, wasn't he?
Well, he's down 45,000. His reasoning was, and part of his question was, do you see a bottom coming soon? Or I think the more important question was, if he buys more today and hopes that it comes back halfway, he'll be able to break even. What do you think of that strategy?
Disaster.
Yeah.
Like, it might look, how do I know? At this point, it's falling. It's like catching a falling knife. It could continue to fall. I thought there was a chance that it could recover somewhere around here, but it didn't. And now it's just kept falling away. So I would definitely not put more money into something that's going bad. It's dollar cost averaging. It's terrible from a risk management point of view. Yeah. So I would just forget about that idea altogether, and then just decide how much are you going to risk, when are you going to sell, put a floor under it. I remember Dale telling me about someone that contacted him about AMP some decades ago. And this was not long after AMP had launched onto the market, and I don't know if you remember, but it actually went through a massive decline. And I just want to share this one because I think it's really important to understand what can actually happen. So this is AMP, and when it listed on the market, this is what happened. Yeah. Now, someone was holding this all the way down. So I think it opened up here and it fell, what's that as a percentage? 80-something%. Now, at the moment, I think the loss on this trade is around 35 or thereabouts. When we were at EDV, we're back at
45,000, yeah.
Yeah, so and that's painful, but just to sit in hope that it's going to come back, I think that's just huge danger.
Yeah.
And, he has to really decide, well, how much is he willing to risk, put a floor under it? It could find support at around $3, but there's no evidence, even on the weekly chart yet, that that's going to happen. So it has to get above this high here in April for me to even think that it's going up.
Yeah, it's hard to call a floor when a stock's in free fall at all-time lows, but I think the biggest takeaway from this is risk management, is going to keep you safe. And hopefully this, you don't make this.
And invest in himself.
Yeah.
That's so important, just to have that discipline that comes from a process that you learn to apply. And I'm getting, from the mentoring, you're working on the mentoring as well, so am I. I'm just seeing that people are having so many aha moments and realising things that they could have done differently. And now that they've got a discipline and a process and a plan in place, it's just going to make it so much easier for them.
Yeah, and if you want to start anywhere, mate, I really encourage you, go get this book. This will give you at least a footprint, a start to go and work out these things and make sure you never make this mistake again, because as you've seen, the stock market's no joke. There's real money on the line and it can really hurt. So please go check that book out. Go to the website and check the course out, even better. But let's move on to Kadam's email, who is next. I would appreciate your view on whether this is an appropriate time to buy CU6 and A2B shares. Could you please advise whether the current price levels present a suitable entry point for CU6 as a short-term investment and A2B as a longer-term investment? All right, Kadam, we're going to do CU6. Hopefully we can cover the next stock in next week's show. But CU6, actually, I'll go to Pedro. Pedro, what are your thoughts, mate, on CU6 right now as an investment?
Look, right now, no, that's a blunt answer. I don't see any reason why to buy in technically into this stock. Let's start off with the monthly chart here. You can see that it's a stock that came out in 2021. Really what it's done is this is its natural momentum right here that I've outlined. It did go off that momentum, real parabolic back in 2024, but it's just come back to that natural trend. And the real risk is that it will come back down to it right now. And it does look like it's trading towards that level there. So there could be a further fall of at least 20%. So that's what you're actually willing. That's what you're bound to risk if you get into this stock right now. And you can see that in the monthly chart, it's just breaking lower lows constantly. We had that low there, and then another low, another low. It just keeps breaking it to the downside. So right now, structurally, this does not look like it's supporting that move up. When we go to the weekly chart, what I mean by no signal right now, it's actually it's a signal that it's weaker rather than strong, because that $3 level was a very important level multiple times. It was a previous all-time high and it was a previous support level, and now it's traded below it. So until it dips its head back above there, and until it can break that downward momentum that it's established from that peak there. So right now, the longer-term trend is down. So you would assume that it will continue to the downside. There's plenty of risk on this one. I would think that if it does find support around this level here, around that $2, then possibly could find some support. But I mean, all the technicals are pointing down right now, so no reason to get into this stock at the moment.
All right, good advice. Now let's move on. Zach is next and writes, thoughts on core lithium CXO chart setup. Had a nice move up some weeks back, looking like it's back testing a critical level of support at the moment. Janine.
Okay, let's get into the chart and have a look at it, shall we? Okay, core lithium, we've got the monthly chart there on the left. You can see, I think we've covered this one in a recent show that we've done. There's a really important level across here. It really needs to get through that before we know that it's on its way. But I just like the fact that we've seen it come off these lows. It's consolidated. We've got some support underneath this. I just think it looks like it's setting up ready for the next run.
Yeah, you know what's good about lithium? I mean, there's been so much talk about lithium over the last couple of years about whether it's going to go up and all of that kind of stuff. But and I want to pose this question to you, Pedro. We are now seeing lithium, run up or print higher prices for the first time in a very long time, and over a decent time frame right now. So, is this really the start of the next bull run for lithium, or are we just in some kind of short-term reaction before the market spikes back down?
Well, I think it's a mix of both. We did see a short-term reaction to the oil price spike in the Middle East, and of course, refined into petrol, and that translated into higher petrol prices. We saw record levels of interest in electric vehicles in Australia, and I suspect that around the world it's the same trend. So they're expecting more and more interest in that EV story, and a lot of countries haven't abandoned that net zero projection as well. So renewables are still in play. And batteries are still in play as well. So I do believe that we had that short-term spike for that reason, but I think that the overall projection is still to the upside for lithium.
All right, Zach, thank you very much for that email, mate. Hopefully that gives you some information on CXO. Now time for our hot stock tip this week. Pedro, what have you got?
All right, I've got a beauty this week, and the hot stock is Kogan.com, ticker code KGN. Now, Kogan came out with a strong business update today, with gross sales growth accelerating more than 24%, while profitability continued improving across the core business. Management also said that the company is tracking forward to the top end of FY26 guidance as margins improve and the Mighty Ape turnaround gains traction. They also continued buying back shares, which signals confidence in the outlook. So let's get into the chart and see what Kogan has done. And today it's gone quite crazy here in price. I'll just quickly switch to the daily and have a look at that volume. I'll expand it out so you don't need glasses to see. I'll just quickly show you guys. This is today's price action, and off the back of that report, it's gone up 18%. With volume as well. So for me, this is a canary in the coal mine. I think that it is the start of something rather than a short-term move, because when we have a look at the overall picture for Kogan, this level here, where it's recently bounced from, has been such an important and critical level for the stock, even all the way back to 2018. It bounced off that level. It bounced back in 2020 from COVID. It came back after that massive run that it had in 2022, bounced from it again. And now more recently, again, back in November 2025, bounced off that $3. February 2026, bounced again. I mean, it's only a matter of time until that floor provides that next springboard for that long-term up movement. So what's the level to watch out for to the upside? I'd say around that $6.50. And that to me represents a nice risk to reward ratio there, because back to that $3, we've got roughly around that 23%, but to the upside, you've got 60%. So that's, a 1 to 3 ratio that is pretty nice at the moment. So let's go to the weekly chart, quickly outline what I'm seeing here. And I'm seeing something similar to what we saw back here in 2022, that sideways action that we saw back here, that eventually had the share price trade from the low all the way up 200%. So if it's going to repeat that back up to that level, that 200%, then we could see price actually go a little bit further, all the way up to that $8.80 to that $9, which was also a previous support level back here. So I think it's got great potential. More conservative, obviously, play would be to wait until it breaks above that $4.20. Again, that is a very important level. And I mean, look at the technicals on this one. It's such a technical stock that that level has provided a floor and a ceiling for the stock multiple times. So I'd like to see it break above that $4.20. I think this is a positive sign and a good turnaround for the company as a whole. So well done, Kogan.